We're looking at the Fed funds rate over the past three major tightening cycles, 94, 99 and 2004. The red line shows the average of the three tightening phases. Now, if I was to include the average for the Fed funds, you can see that starting at point 0, so that's the beginning of the tightening phase, Fed funds has risen by about 250 basis points over an 18-month time period before beginning to decline on average over the following 12 months. What is the FOMC currently projecting? And if we now use if today, and I'll put in the FOMC forecasts, that's the red line, you can see that they're expecting a trajectory that is lower than what has typically happened in market cycles in the past. But the other observation to make there is that it continues to rise on a longer term basis, whereas by the period 18 months to 30 months, typically Fed funds might be beginning the down cycle. Now, if we use the leaked Fed funds forecast, that's the blue line, you can see even a even lower trajectory of around about 50 basis points below that of the FOMC. And then finally, what the market is implying most recently, that is the red line there now, and that is showing the Fed funds rising to only around about 60 basis points in 12 months, by about 80 basis points in 18 months, so a much lower trajectory. So I guess the observation to make here is that the experience certainly of the past three tightening cycles has been that rates rise by a lot more and a lot sharper than markets have expected, and certainly what currently is being projected and expected by the FOMC and also markets, but also that there's a cycle to cash rates and they have tended to decline in the back end of that 30-month projection period. I want to also have a look at the concept of the equilibrium real rate, or the neutral rate of interest, because I think it's important in terms of what sort of trajectory the market is going to be looking at for Fed funds rate once the process of normalization begins. So let's just start with a quick look at the output gap in the US. So we can see here the blue bars represent the output gap as measured by the IMF going back to 1980. So this is significant excess capacity within the economy in the early 80s. And then likewise, since the GFC, there's been a very large negative output gap that is projected to narrow over the next couple of years. So I want to now add the Fed funds rate to the chart here, and let's just put that in. So this is actually, rather than the Fed funds rate, we will choose the real Fed funds rate. You can see there the red line now on the left hand scale. So this is the real Fed funds rate. It's currently sitting at probably around about minus 1.5%. That is based on obviously zero Fed funds less inflation of around about 1.5, 1.7. So a real Fed funds rate very low. Now the Fed and Janet Yellen have been discussing to some degree in recent times the level of the equilibrium real rate of interest. It's the natural rate of interest, if you like, the rate at which the output gap, whether that be measured via the unemployment rate or by inflation relative to its target, or obviously a combination of the both, when that's in balance, when the economy is operating at its full potential. So it's the level of interest rate that is consistent with that outcome. So the Fed has used some work done by the San Francisco Fed, and we will use that here. And that is the gold line. So the estimates of that, as we can see here, have been fairly consistently around about the 2.5% to 3% levels, gradually coming down over the past, say, 20 to 30 years. But prior to the GFC, the gold line there, the equilibrium real rate estimate from the San Francisco Fed, was sitting at around about 2%. At the time of the GFC, they've estimated it's come down to basically a slightly negative position at the moment. So if we look at where the actual Fed funds rate in real terms is relative to what is seen to be the neutral level of interest rate, you can see is quite a difference. Now, another way of showing that is to add that the difference, and we'll put that on the right hand scale. So the blue line here is now showing the difference. So when the blue line is above zero, as we see here, that means that policy is tighter. It's trying to slow the economy down, and one would expect that when the output gap is above zero, i.e. the economy running above its capacity or above its potential, the Fed will generally have a tighter policy. And certainly if we go back to the early 1980s during the Volcker period, where the Fed was actually trying to stamp out inflation, despite an output gap, they were running a tight policy. But as we go from beyond that period, you can see it matches more closely what is happening to the output gap. Some of the standouts or inconsistencies would appear to be in the early 2000s, where policy was actually very loose relative to what was seen to be the neutral rate, despite an output gap being fairly small. So policy was very loose during this period. And likewise, the most recent period from the GFC on, you can see that despite a very significant output gap, that policy was only marginally easy relative to the neutral rate. And the problem there, of course, is that with zero Fed funds rate, it was very difficult to get the real rate of funds down. The only way it could be done is by increasing inflation. So as the economy is projected to move back into balance over the forecast period, both by the IMF and also by the Fed itself, with unemployment coming back to the Nehru level, which is around about 5%, and inflation getting back closer to target, the gap, this blue line, should also move closer to zero. And what that would imply, therefore, is that the gap between this red and the gold line would narrow. So if we think that the neutral Fed funds rate will remain around about zero, and therefore in order to get back to that level, we would need to see the Fed funds rate lift by about 150 basis points. So in nominal terms, what might that look like? You can see here, there's the nominal Fed funds rate close to zero, and this is the so-called equilibrium nominal rate in gold. That 150 basis points is essentially what's being implied by the market itself. So that is a level that what the market is currently pricing in is very close to what would be implied by a narrowing of the output gap or a correction of the output gap back to zero, and with the equilibrium real rate staying roughly where it is, very close to zero. The FOMC, on the other hand, has rates moving to 2.8% over the next year and a half or so. So let's just look at the FOMC projection. That is now the green line. That's looking at a more of a lift in rates. And so that has to come from not only a narrowing of the output gap, but also via an increase in the equilibrium rate from the current zero level to something like 1%.